So when you think about dividend investing, it seems like there's some sort of obsession that people really like dividends. Is the fact of maybe getting paid on a monthly or a quarterly or a semi-annually basis that makes it very exciting, or the fact that you can easily calculate the return, which makes it very enticing to new investors. But if you are planning to grow your portfolio significantly over the next 5 to 10 years, then you probably don't want to be investing in dividends. But if you want to have some sort of income, some sort of predictable cash flow, then dividend investing might be for you. Now, in this video, we're going to take it slow. We're going to go through how I would find dividend stocks that gives you 5, 6, 7, or even 8% return or higher, and how I would filter for them. So we'll go through this step by step. You can treat it kind of like a live stream where I'm not going to be editing this video because it's just going to be the raw cut. And I'll just walk you through each part so you have a sense of how long each step take. And it's not that complicated. It's not rocket science. So anyone that is above 18 or even just above 12 years old can probably do this. So it's just a matter of knowing where to go and where to look. So let's get started then. So first, the website I'm going to be using is called FinViz, and then afterwards we're going to do some analysis here within Tradingview. So before we start, I just want to talk about the return. Now, when you first started out as an investor, you might be in one of the 3 categories. So the first one is negative return. Now, you'll usually end up with a negative return if you try to manage your own portfolio. If you have an incomplete strategy, you might get a negative return. Or if you just invest before a market crash, you might get a negative return as well. Or if you invest in some risky stocks at an absolute high, like the tech correction, then you'll get a negative return. So this video is for you so you can get a positive return. Now, the second group of people is really people who get around 5 to 10% return a year, and you want to be more dividend focused. Now, if you have been investing in the S&P 500 for the last 5-10 years, then you'll probably realize that the return is around 5 to 10%, maybe around 15% up to, depending on which year you're looking at. So these people usually have a balanced portfolio, and you want to learn how to get a high dividend from your portfolio because you're looking for some sort of cash out. Maybe you're looking to get a dividend income so then you have a more predictable retirement. Maybe you want a dividend just because your friends told you it was a good idea. So then you can get taxed on the dividend amounts every single year. So I was being a little bit sarcastic because when you look at dividend income, you get taxed on an annual basis. And if you don't use that money and you reinvest it, then it's just like a self-inflict pain where you let the government tax you on the dividend amount and then you kind of put it back in the stock market. So the question is, why do you want to go through this process? And the only reason I can think of that is beneficial to get dividend is when you want to have a more predictable retirement. Or else you will focus on capital gains, which brings me to the third part. So 30% per year is something I talk a lot about on my website. So that's actually where I have a very detailed, intensive training in the description link, which is called How to Get 30% in 12 Months. So if you go to the first link in the description, then you'll get access to that training for free. So yeah, if that's what you're interested in, which is a completely capital gain focused strategy, then you can go to the description below. Okay, so that's where we're at. So this video is really targeted to get you to the middle part where you're getting a high dividend income and at the same time low management or as little management as possible. So to execute that, we need 2 things. FinViz, which is the website, So here, if you don't know how to get here, is FINVIZ, Financial Visualization. And within this website, there's quite a number of tools. And our goal this time is to get dividend stocks that is 5, 6, 7, 8%. So what we do is we go to the screener and we just filter by dividend yield. Now, before I actually click the button, you'll be like, wow, Eric, that's actually very simple. And well, I would say there's no magic to it. And once you click, on the filter, then you have a list of stocks that gives you 5, 6, 7, 8, 9% dividend. Now, when you're thinking about dividend stocks, there are quite a number of considerations because you want to invest in good dividend stocks. Just because something is giving you a dividend doesn't mean it is good. And second, you want to consider your industry. So that is something I talk a lot about in terms of diversification within Investing Accelerator, is how to control your exposure to a specific sector. Now, here you can see our filter is actually at 5%. And what you'll find is that a lot of these high dividend stock symbols are actually in the real estate industry. And as you go along and you increase this filter to 6, 7, or 8%, then you'll find more and more real estate REITs. So that's just the nature of it. Usually REITs give you a high dividend, but in return, you get less capital gain. So my alarm just went off, but no worries. So we can continue. So, okay, right now you can see that there are 31 pages here. So that's actually quite a number of pages. And I don't think you should go through all 31 pages. It's just a waste of time. So one of the first things you want to ask yourself is really, well, how much do you want to invest in dividend? Is it the entire portfolio or is it just a portion of the portfolio? Now, this question actually relates to the overall diversification strategy of your portfolio. So let's say is 20%. Now someone is going to be aggressive and say, okay, I want 100% dividend, but that is going to be your choice. So let's say it's 20%. Then the question is, well, how many dividend stocks do you want and in which industry? So if you have a preferred industry, then of course, just go ahead and select that industry. Now, when it comes to dividend stocks, I think real estate investment trust is probably the best because they usually have high dividend and they're relatively straightforward. And I think real estate is something that a lot of people understand. Now, of course, you don't want to be investing in real estate if you think there's going to be a real estate crash. And if you look at the YouTube recommendations or whatnot, you will find a lot of videos that talk about an upcoming housing crash. So if you're scared of that, then you can avoid real estate. Now, with 31 pages, that's still quite a bit to go through. So what you can do is you can filter by market cap. Now, when you're filtering by market cap, one simple way to understand it is really the larger the company, the safer it is. And you want to avoid investing in penny stocks or small caps or whatnot. So just for a no-brainer rule, then you can invest in things that are mid-cap and above. Okay, so that's very straightforward. I would say that is a pretty simple filter. So it is adjustable. If you have more experience when it comes to managing your portfolio, you can relax this constraint. But I would say 95% of the people here on this channel, you probably want to stick to this filter. Okay, now most of the time when you're looking at dividend, 5%, I would consider that to be medium high. So it's not super high, and anything close to 10%, I would consider that to be very, very high. So if you want to be a little bit more aggressive, then you can perhaps aim for 6, 7%. But then the higher you go, there's actually a downside to investing in dividend stock. So the higher the dividend, the lower the stock price increase. So when you're thinking about a high dividend stock, you want to make sure that you're not compensating from the stock price, because the last thing you want is you get paid a 7% dividend, but then the stock price went down 7%. So that just defeats the whole purpose of a dividend stock, because you're just exchanging your stock price into dividend income, which you get taxed every year, and then afterwards you have a capital loss at the end of 10 years. So that's what you want to avoid, but of course it is actually very difficult to pull off without any capital loss when it comes to investing in dividend stocks. There are some examples which we'll try to go through and we'll analyze, and I'll tell you how to find them in this video. Okay, so now when you look at this filter now, there are only 6 pages, which is a lot more manageable. And here you can see again, real estate, financials, there's some energy. So those are really typical sectors that would give you a high dividend. Tobacco, oil and gas. So I would say if you're looking at the big categories, utilities, REITs, oil and gas, consumer goods, like will give you high dividend as well. So now this is much more manageable. If I go to page number 6, there's only 100 of them. So for example, ExxonMobil, I'm sure a lot of you know what that is. So yeah, I would say this is a more manageable list. Now, of course, if you are working full-time, you're a busy professional, you're not going to want to go through 100 companies, do the technical and fundamental analysis just to figure out whether something is a good pick or not. So at this point, you can select something like a sector. Now, if you know or are familiar with a very specific sector, then yes, go ahead and select it. But sometimes you might not get high dividend in a specific sector. So let me just try technology right now to see if there are any. And the answer is no. Because when you think about technology sector, you usually get high growth companies that are loss-making. So they focus a lot on innovation. So they're not going to be giving you a 5% dividend anytime soon. Instead, they'll focus on reinvesting and doing R&D and so on. So if you're an engineer or a scientist and you like the technology sector, then well, you need to look in another sector for high dividend stocks. So most of the time you'll find real estate. So here you can find it's 2 pages. I would say utilities. Here you can find there's a page. And probably energy, like oil and gas and stuff. But if you don't have any sector, then just pick any. Then you just need to use other filters. So okay, now let's go through a couple of these. And if we want to make this list more restrictive, then we can actually choose large cap. So I think that is actually okay. Picking a larger cap just makes it safer. You can pick mega cap, but I think large cap should reduce this amount significantly. So now we're down to 3 pages. So this is much more manageable. So let's analyze this one by one. So I know I have a lot of subscribers that are in US and Canada. So in this case, we'll probably focus on the US and the Canadian ones. So let me just pick one that is, Chevron, CVX. So first of all, when you're looking at this chart, for those newcomers here, I actually have a training on how to set up this chart on Tradingview, which is a free software. And the training is the first link of the description below. It's actually part of the How to Get 30% in 12 Months webinar. So just to give you a quick background, here is the Bollinger Band. So that actually gives you a sense of what the 2 standard deviation of stock ranges is for the last 20 weeks. If you don't know what that means, you need to go down and watch the training. The red EMA is 100 EMA, which stands for the average price for the last 100 weeks. And the blue EMA is 200 EMA, which stands for the last 4 years, the average price. So those are really the key technical indicators that we use in Investing Accelerator. So it helps us identify a low price to enter. It helps us to find good entry and exit points. And as long as you understand the tools completely, figure out where to get in and get out, technical analysis is what you need to master. So again, the free training is in the first link in the description below. So okay, now when you're looking at Chevron, let's look at pre-COVID time. So this is an oil and gas company, right? And if I go to pre-COVID, then here you can see, well, the trend itself is actually relatively flat. Now, some people might argue with me that, hey, from 2015 onwards, there is kind of an uptrend, but well, the answer is, if you look at the last 2-3 years, I would say is pretty much flat. And sometimes the reason is because Chevron gives a high dividend. And that completely makes sense, and that's also fine. because what you're aiming for, in this case, is not capital gain. What you're aiming for here is dividend percentage. So whatever growth that Chevron might have will turn into dividend, and I'll get paid out to you, and you just pay the dividend tax, and you get a predictable amount of dividend each year. So when you're looking at this chart, this is actually fairly good for a dividend stock. And the reason is because you don't want to get a stock that has a downtrend. So for Chevron, the chart itself is fine. Here you can see it is relatively flat, which means the company is paying you dividend without sacrificing the stock price. Now let me try to find an example where that is not the case. And I'll just go through a couple more stocks here to show you what I mean. So they actually don't show you what the dividend is unless I click into it. So if I go into here, okay, so dividend for Chevron is 5.26%. So that is not bad. Let me just write that down. Okay, so the trend itself, it's fine. We know it's flat, and that's what we would expect. Now, the second stock, let's try to do this one, Carnival, CUK. Now, when you're looking at Carnival, what you want to look at, again, is the trend. And this time, let me just click into it to figure out what the dividend is. The dividend you get here is 9.82%. So this is actually very high, almost double of Chevron. So let me just write that down as well. CUK, 9.82%. So the good thing about Carnival is, well, high dividend. Now, if you're just judging by this number alone, then hey, maybe it seems like a great idea. So that's why you need to jump into technical analysis. Now, before we look at the chart, which you can obviously see here is a downtrend, what's important is that after you do your technical analysis, you also need to analyze the fundamentals, news, so on and so forth, to make sure it is a good investment. I would say technical analysis is only around 10% of my investing strategy. So what you're seeing here is really a few steps within a giant investing plan. So that's what you're looking at. So if you scroll back a little bit, just before COVID, now this range is actually quite wide. So this is between 34, 35, all the way to 70. So before COVID, the range is between $35 to $70. So if you think about Carnival, then you can see, okay, initially this might seem like a good idea when you're investing during this stage, but then afterwards, there's starting to be a downtrend for Carnival. So the problem with stocks that has a downtrend and pay a high dividend is that sometimes they might not make enough money to pay the dividend, so which depletes their cash, or if their revenue growth is not sufficient to compensate for the dividend because it's 9% and so high, that would lead to a downtrend. So what that means is whatever money they give to you, in the end, they paid it through a decline in stock price. So let me illustrate what I mean. Now imagine you invested in CUK in the beginning of 2018, which is at around $60, $70. So $68, $67. And then afterwards, you hold it for 1 year. Now within 1 year, let's say you make 10%, which in this case, the 10% is actually calculated with this stock price, not at $68. So if you make 10% here, being very aggressive in this case, then let's look at how much the stock price has declined. So it went from 68 down to 50. So let's use a round number. Okay, so let me pull up my calculator. So 50 divided by 68 here is 73. So minus 1. So the drop is 26%. So that means if you invested in Carnival in 2018 and you got a dividend of 9%, but your stock price lost 26%, in the end, you still lost money. So you actually didn't make more money by investing in Carnival. And that is the biggest problem with investing in dividend stocks. And that's why when you're looking at the dividend number, you actually need to look at the chart as well. And then afterwards, you need to look at the financials as well. It's only when you combine the technical and fundamental analysis, then you will be able to find good dividend stocks. And just by doing the steps I showed you here, get the template, look at the trend, and so on, then that will already improve your entry points and also help you find high dividend stocks. So if dividend stocks is your forte or pet peeve, then this is what you would do. Now let's go find another one. Given that we only have a list of 3 pages, I think it's relatively easy to find. So next one, let's look at PPL. Now, do we want to look at this one? If I remember it correctly, this is actually a utilities company near California. It got into quite a few issues with the whole power grid, with how it was out because of the wildfire and whatnot. So we can look at this one. I think it's probably going to be a downtrend, so let me just take a look at that. PPL. PPL. Okay. So surprisingly, it actually has a relatively flat trend. Let me just double check the name again. Yeah, PPL. All right, so let's click into this and look at the dividend. So dividend itself is 5.91%. Again, you need to do fundamental analysis on this before you invest. So let me just write this down. Now, when you're looking at the chart, here you can see, well, there is COVID, but if we kind of ignore COVID and we kind of take into consideration from 2016 onwards, then you can see that generally it has a slight downtrend. So ideally, if you cycle through the list, the 3 pages I showed you earlier on VinViz, then you want to avoid stocks with a downtrend. Now for this downtrend, it's not really that severe. So you can see from October onwards, it's actually pretty much flat. But when you think about the company, you also need to consider the growth prospect of PPL. So if the growth prospect for PPL is very high, there's high growth, then perhaps there is going to be an uptrend in the future. But if you look at the historical data right now, then you can see that the overall trend is just hovering within this range between $23 to $40. So this is the last 10 years. So unless there's a significant change for this company, then you're not going to get a huge increase in terms of stock price. So that's how you think about it. So if you invest in this company and it went from 28 to 25, well, should you panic? Well, the answer is probably no, because if you look at it the last 10 years, the range is between 22 to 40. So there's really no need to panic just because the market is fluctuating a little bit. And plus, if your goal is to get this 5.91%, then it's just a matter of holding on to the stock for as long as possible. So then you get the dividend over and over again. And if you are able to hold on to the stock for a couple of years and you get 6% per year, and even if the stock price didn't move at all, then hey, you're making 6% per year. So that's actually not bad, given that you're investing in a dividend stock. Now, having said that, when you're looking at your return, you do need to compare with the return of S&P 500. And for the last couple of years, S&P 500 has been crazy given all the money printing. So it's somewhere between 10% to 15% return. So if you look at a dividend stock, like 5.91% is already considered to be pretty high, and their trend is flat, then this is actually behind S&P 500. But this gives you a predictable cash flow per se. Well, as predictable as possible compared to capital gain. Now let's look at another one, Pembina. So for this one, PBA, I actually think they are a pretty good company. There's a bit of news around it in terms of acquisition for Interpipeline. So here you can see before COVID, the trend itself is not very strong again. And this is usually because of the dividend. So it's not like there's something wrong with the company inherently. But Pembina, PBA, the dividend is 6.64%. So again, this is another high dividend stock. I think it's an oil and gas company. So it's just a matter of, well, if you invest in this stock at around $30, which is what it used to be for the last couple of years, then it's just a matter of hoping the stock price will remain the same at this level. Now, when you're looking at these stocks, like I said, you need to look at the technical side, which now you know how to do it, and you can just refer to the first training below to set up your charts to look like this, and fundamental analysis together. And you also need to look at news and other things so then you understand the investments you're getting into. So then just because the stock price for a Pembina might fluctuate from 26 to 30 or 30 to 38, you're not that surprised because what you're aiming for using the stock is really the dividend amount. So you're not trying to get an outrageous capital gain like some of the meme stocks recently, or you're not trying to get rich quick and become a millionaire tomorrow investing in these stocks. So these are relatively stable companies and they have a solid, mature operation. So yeah, it's just a matter of holding on and getting dividend. So that's how you would think about dividend stock and how to build that to your portfolio. So when you're thinking about your portfolio allocation, chances are it's not going to be 100% dividend stocks. If you really want, then, well, you need to think about maybe it's 20%, maybe it's 30%, maybe it's 50%. It really depends on the amount of income you want. And just from a quick filter, quick search, quick technical analysis, you can see we can already find stocks that have a dividend amount of 5, 6 to 7%. So that already gets you pretty close to 7%. And compared to some of the mutual funds you have or your existing strategy, it might already be performing better. So that gives you incentive to just switch over and use a buy and hold strategy. So when you think about how easy it is to get 6-7% in a stock market, that would be the benchmark. Basically people who invest in index funds, people who invest in dividend index funds or just high dividend stocks will be able to get this level of return. So if you're looking to make a more aggressive return like 30% or whatnot, then you really need to use a more advanced strategy. So that's where the free training in the description comes into play, which is called How to Get 30% in 12 Months. And you can refer to that if you're interested in knowing more. So let's see if there's anything else I want to cover for dividend stocks before I wrap this up. Okay, so there's one more thing I want to talk about, and that is really on the amount of money you need to retire as a dividend investor. So there are actually quite a number of videos that cover this topic already on YouTube. Like I've seen people estimating how much dividend you need. So basically, the first step is really to calculate the amount of expense you have. Now, as a retired person or a full-time professional, if you're planning for retirement, you're probably estimating somewhere around $50K per year in terms of expenses. And so this includes food, travel, housing. Probably you would pay off your mortgage by then. That's the plan. And $50K per year is quite reasonable. So when you think about it, okay, if you're only getting a 5% per year dividend and assume your entire portfolio is dividend, then you really need $1 million. And if you're looking at the other YouTube videos online, then yes, that's kind of the conclusion you will come to, is that you need $1 million in order to get a $50K per year dividend income. Yes, there are some ways to go around it to basically leverage and multiply that dividend amount. But I would say those are more advanced strategies. And most people who are playing it safe, getting 5% per year or whatnot, it's going to come to the realization sooner or later that they need $1 million portfolio. So, well, the question is, if you are working full-time in your 30s, 40s, or 50s, how do you get to $1 million as soon as possible? And that's actually quite an important question because your strategy actually evolves over time. So when you are in your 20s, your strategy should be different than your 30s, 40s, and 50s. when you're in your 30s, 40s, and 50s, you're actually in a much more mature state in terms of your career and also your income earning potential and stability. Well, you also have a family and kids, so that's going to be a whole different story and another layer of expenses. But your goal during this 30-year period, 30 to 60, is really to save and invest in such a way that gets you to $1 million ASAP. Because once you reach $1 million, then you can just go invest in one of these dividend stocks that I show you here and get your 5, 6, 7% per year. And then you cannot work. So that first million is really most of the barrier that people will encounter. So that's why I said when you are choosing to invest in dividend stocks, you need to think really careful about why you're investing in dividend stocks. Because if you're investing in dividend stocks when you're in your 30s, 40s, and 50s, then you might regret not being aggressive during this 30-year period of time. So that's why when I'm investing, I focus on a higher return because I know right now I don't need to rely on dividend income. And I want my portfolio to grow as much as possible without getting taxed by the government multiple times. So this means if I invest in dividend stocks, every quarter they pay me money, I get taxed on it, and I put it back into the stock markets. So you can see how redundant that is and how that can slow down your portfolio growth significantly. And that just means you would work extra years by using a dividend-focused strategy too early in your life. So when I'm talking about a dividend-focused strategy, I'm actually also talking about bonds, real estate investment trusts as well, where there's a very strong emphasis on cash flow. And that's why you need to kind of look at your situation, understand where you're at, and if dividend is really what you want, then hey, great. You can go to FinViz, you can pick up some high dividend stocks that has a relatively flat trend or uptrend, and then you just invest in them and hold. Then it's a very predictable, hands-off, no need to worry about a strategy. There are also some dividend ETFs you can look into as well, but we wouldn't be covering that in this video because you can just do a quick Google search. So if you are looking to go from, let's say, 100K to $1 million, then perhaps dividend strategy is not the best way to get there. Because the last thing you want, is to get taxed multiple times for your portfolio value. And if you're in Canada and you're using something like a tax-free savings account, then you want to avoid investing in US dividends because there's like a withholding tax every time they pay you because US does not respect the tax-free savings account status in Canada. So as of the time I'm recording this video, this statement is still true. So it might change in the future, but I don't think it's going to change anytime soon. So I think I've achieved the goal with this video is to get you to this 5 to 10% per year using dividend stocks. And if you, let's say, invest in 10 or 20 dividend stocks that you're familiar with the company or the industry or you have done your research on it, then you should feel pretty comfortable with your portfolio. And once you set that up, it's just a matter of buy and hold. So then you just get paid on a regular basis and make sure you do your taxes on an annual basis so then you pay the proper amount of taxes to your favorite government. Okay, so that's pretty much it for this video. And I'll talk about how to invest in the stock market more next time.